a great pleasure to welcome Marco Friel. I've known Mark since he joined Steel Partners Japan back in 2008. Mark is a true veteran of Japan, having worked there on and off since the 1980s, I believe. After a long career at Morgan Stanley, including as head of their equities division in Japan, Mark moved to the buy side, first running an internal hedge fund for Morgan, then as head of Steel Partners Tokyo office in 2008 and 2009, and for the past few years managing his own firm, MOF Capital, which is focused on investments in Japan as well as in China. Today, Mark will share his insights and provide some needed perspective on the question of whether the activist experiment in Japan has failed or is it just on hold. Certainly a very timely topic given the mixed experiences of so-called activist funds in Japan. And with that, Mark, the floor is yours.
Good afternoon. Thank you, John, Oliver, and all of those at the Value Conference and Manual Ideas for inviting me to speak at this Value Conference on Japan. I'm an advocate of online learning. It's one solution to broaden exposure to ideas, so I'm very interested to see how the online experience plays out in the business world, and I'm honored to be invited to be part of this virtual conference. The American writer Mark Twain is often quoted as saying that history does not repeat itself, but at best, it sometimes rhymes. When I first arrived in Tokyo in 1984, the Nikkei average traded in the range between 8 and 9,000, about where it trades now, nearly 30 years later. Imagine the state of the world if the Dow Jones index were trading at 1,300 and not 13,000, or the FTSE was at 1,000, not 5,000, as it is now. My job then, as a young analyst for Sanyo Securities, was explain to foreign investors why the valuation of the Tokyo market was so rich. The P/E, price-earnings ratio, of the market then was over 50. And mind you, this was in the days even before the market stretched to 39,000. Now, I'm not sure what the rhyme is, but these days, I find myself trying to explain to investors why the Japanese market is, by many measures, one of the most undervalued in the world. In these days of overvaluation, investors found many ways to explain the issue. Often cited were some things uniquely Japanese: cross-shareholdings, undervalued assets, and Japanese corporate governance structure or investment memes. Ironically, we see now that some of the same explanations for the current low valuation. So what brought change to the overvaluation? There was a change in both the investment base as well as the market structure. The flood of foreign analysts in the late 80s and early 90s helped to determine value. This was one outside influence. But there was also structural change. The introduction of bond index and stock index futures, the ability to short sell, and the increase of hedge fund capital provided the catalyst to bring valuations back into line. Now as then, to change the impression of Japan as a value trap, there needs to be a catalyst. There needs to be change to market structure and diversification of investor type. A couple of weeks ago, in the FT, John Bogle stated in another context, but I think it applies equally to Japan, that global institutional investors, including the largest, like Vanguard, BlackRock, State Street, Fidelity, and American funds, have been conspicuous by their absence from exerting significant influence on the companies that they collectively own. John Bogle stated that the silence of the funds has been deafening. The managers overwhelmingly support existing boards of directors and managements, and not one of the above managers that he stated has submitted a proxy proposal in the face of management opposition. Here at the Value Conference, we are trying to answer two questions. One is, what is value? The second, how does the value get unlocked, and what is the timing of the change? It is little use if we can agree on the first point but can't find the answer to the second. Examining the question of what could take Japan out of the value trap, I conclude that one answer is to look at the structure, the players of the capital market. I think that if there were more activist shareholders, more private equity, then there would be more spin-outs, more M&As, and perhaps companies would be more fairly valued. The counter-argument is that activism does not work in Japan. Evidence is given largely because of the withdrawal of former players and the current absence of hostile activists. I often read the argument that if there is to be activism, then it must be of the, quote, quiet type. Quiet activism, as one type of value investment, can also be successful. But by definition, quiet activism is at best helping companies to do what they already wanted or planned to do. I argue that the absence of activists is not evidence that activism does not work. Rather, it is an opportunity of an arbitrage that is available in Japan for those with the skills and inclination. Empirical studies show that hostile activism in Japan does work. The fact that some major funds floundered was either fund-specific or related to liquidity issues that came about as a result of the 2008 financial crisis. For the remainder of my talk, I would like to touch on the history of activism, look at what worked, and speculate about what the future of activism could be in Japan. Wondering whether activism will come back, we must understand why activism drastically receded after the explosive growth in the first part of the last decade. Very briefly, there have been two waves of activism in Japan. The first was short and tentative. The second was broader, with clear results. Boone Pickens was the first activist. His target was Koito Manufacturing, a small captive supplier of Toyota Motor. His thesis was that captive suppliers to large manufacturers artificially lower prices to support the large affiliates. Also, those suppliers self-constrain their growth of market share by refusing to sell to competitors of the parent organization. Pickens, of course, met with hostility in the media, bureaucrats, and legal system. Nor did other shareholders support his efforts. He withdrew with nothing to show. Lessons learned were that powerful interests resisted activists in Japan. Finding cheap stocks was the easy part. Being a catalyst for change was difficult. Though in the 90s there was an era of rapid growth of hedge fund activism in the US, Japan remained dormant. The second round of activism began in 2000 and lasted for 8 years. And it lasted because it worked. Returns were initially quite high for activist funds. However, a combination of internal and external events brought this era to a crashing halt. Murakami launched his first fund in 2000. His success was in stimulating balance sheet restructuring. His investment targets increased cash dividends and share buybacks. The Murakami Fund was successful due to the fact that he uses expertise developed at MITI to understand the legal rights of shareholders. He legitimized the stature of the activist investor. Because he was a domestic player and a former bureaucrat, he broke barriers that had existed since Pickens had withdrawn. After Murakami, foreign funds with capital and expertise built up in the 90s in the United States saw there was opportunity in Japan. So began an activist era. There were several types of funds that explored activism. First, there were those with experience in activist activity. They brought analytical, technical, and legal expertise, as well as corporate advisory teams to Japan. Then there were some value funds, which used the activist brand to enhance their marketing. These were the quiet activists. Yasushi Hamano of USC and Kenji Kutsuna of Kobe University have created the best empirical study of that era. They have compiled a comprehensive database of activist funds and their track records as activists for the period between 2000 and 2009. Hamano's results for the entirety of that period, which includes the financial crisis, show a positive stock price reaction to the announcement of activist investments, particularly for events involving hostile funds. Led by Steel Partners Japan and TCI, as well as Murakami, there were 34 funds that Hamano identified as activists. His definition is fulfilled by two criteria. There must be a filing for at least a 5% stake in the company at any time during the period study. And with that filing, there must be a formal request for a change that could be described as a significant proposal or corporate action. Half of those 34 funds are defined as hostile activists. Hamano goes on to define hostile by reviewing media records. 40% of all the filings were by hostile activist funds. Over the period of time, the scale of the activist effort was not insignificant. Over 10 years of the study, nearly 800 firms were targeted. There were several standout success stories, as well as more minor ones. Myojo Food was led to merge with Nissin Noodles. This led to consolidation and increased efficiency in the domestic food sector. Management at Adirance, now Tokyo Hair, was restructured after a proxy fight was won by Steel Partners in 2009. Insiders were forced out, and a Western-type board with strong independent directors was voted in. In aggregate, Hamano shows that the stock price response to activists was quite positive and outperformed the market. Moreover, hostile activist targets showed a reaction twice that of the targets of non-hostile activists. Finally, the most notoriously hostile of the activists, led by Steele and Murakami, were by far the most successful in their outperformance. So what supported this era? First, low valuations after the dot-com sell-off in 2002 and 2003. Value analysts had a target-rich environment. Two, there was and still is a strong legal framework for minority shareholders. These shareholder-friendly rules were researched and exploited by funds. Shareholder voting rights are famously more supportive in Japan than in the US. Just as famously, those rights are not exercised. Just for example, one round lot gives a holder ability to bring a lawsuit for shareholder damages. 1% holders can bring a resolution for a shareholder meeting. 3% holders can audit books and call extraordinary shareholder meetings. and a one-third holder can veto major decisions of a board. A third foundation of this era was that bureaucrats did not resist, and in fact, in some ways, encouraged the effort of activists. Deregulation of the financial sector supported the growth. The Financial Services Agency, MIDI, TSE, and PFA all offered opinion papers that supported the theory of activism. Or maybe at the very least, they agreed that complacent management needed some kinds of checks and balances. They agreed that there was a catalyst needed for shareholder growth. Finally, the era continued, as I stated above, because it was financially rewarding. Hamano's research shows that the returns to hostile activism significantly outperformed market returns during the period. Of the 800 filings mentioned above, attributed to both friendly and unfriendly activists, 250 resulted in corporate actions of some sort. The majority of these corporate actions were stock buybacks or increases in dividends. To a lesser extent, there was M&A activity and asset sales. Measured in the short term, by immediate response to the declaration of 5% stakes, hostile funds targets outperformed the market by nearly 4% around announcement dates. The targets of steel outperformed by almost 8%. This is short term around announcement dates. In the longer term, as measured from announcement of 5% stake to announcement of when the 5% stake was reduced, the outperformance is even more dramatic. Annualized returns of hostile funds outperform a broad-based Nikkei index by an annualized 6.5%. There were also secondary effects on the capital market in Japan. Activism stroked the increase in the trend towards higher dividends and share buybacks, as well as improvements in board independence. The initial success in activist returns attracted more assets to the strategy, especially the hostile activist strategy. In 2006 and 2007, hostile activists were able to increase analysts, legal staff, and lobbying as investments flowed in. Activity ground to halt in the financial crisis of 2007 and 2008. Globally, new investments with all activist funds slowed. But in Japan, the decline was spectacular. Activity by activists, as measured by filings for investments over the 5% ownership level, collapsed from nearly 200 in 2006 and 2007 to 80 in 2008 and only 10 in 2009. Why did this happen? First, there was a problem of fund structure and capital, and second was fund performance during that period. Activist funds in Japan and everywhere were caught in a bind. They were structured as hedge funds and invested primarily in public equities. Their legal structure was liquid. However, they marketed these funds with annual and sometimes even quarterly liquidity provisions. The strategy itself was not that liquid. Activist strategies are predicated on taking strategic blocks of shares and holding them for years. The reaction of many activist fund managers was to maintain the strategy at the expense of providing liquidity for clients. Gates and side pockets were common. Clients demanded redemptions from liquid funds and halted new investments. A second reason for the decline of Japanese activism was that the valuation and strategy didn't buffer the returns of activist funds during this period of crisis. These funds had marketed themselves as having a margin of safety because targeted companies had large levels of cash or other undervalued assets. However, value stocks will correlate to the market, and value investors suffered along with the rest, and perhaps more, in the sell-off of 2008 and early 2009. In addition, because activists and other value managers invested on the basis of this margin of safety, activist funds hedged less or not at all than other long-short hedge funds. This compounded the underperformance of activists versus long-short equity hedge funds. Generally, they were also invested in mid and small cap stocks, which underperformed large market indices. The final element was leverage, which proved deadly to some of the bigger funds. After the crisis, activist funds have made a comeback in the US, but not on the same scale in Japan. In the US, corporate divestitures are back up. Companies are focusing. They are streamlining with spin-offs and sales to private equity. Corporate clarity of purpose has been rewarded. In the US, success rate of investor campaigns has returned to the levels prior to 2008. Why is Japan? Why has it not returned? One reason is that even pre-crisis, how activists realized profits and exited was different in the US. Pre-crisis, the success rates in Japan for activism were rather similar. About 30% of the companies targeted followed through on activist demands in both the US and Japan. In the US, there was more diversity. Sales, spin-offs, taking private, and restructuring were all more commonly represented. In total, they represented nearly half of the results of successful activist campaigns in the US. However, success in Japan was mainly balance sheet related, share buybacks or dividend increases. Post-crash, it is harder to persuade boards in Japan to gear up balance sheets. In fact, CEOs and boards have felt vindicated by carrying the high cash levels they did prior to 2008. What is working going forward in Japan activism is the reduction in subsidiary listings. Subsidiaries have been privatized or acquired by parent companies. So in that respect, post-crisis, the Japanese market has become more like the US in that the ratio of balance sheet actions to corporate actions is more balanced towards the corporate actions. But still, this comes with an overall lower level of activity. Another reason for the lack of rebound of activity in Japan was that the activist specialist funds pulled back from Japan to concentrate on their home country. Redemptions hit, and they had less resources for geographic diversification. Market returns were higher, particularly in the US, where small and mid-cap indices have returned to old highs. Activism, of course, is expensive relative to value investing. Engagement costs of proxy votes, advertising, compliance, etc. are very high. Dedicated Japan funds that were market activists, or quiet activists, returned to roots as value funds. They had really only dabbled in taking public stances and filings with companies. Non-hostile activists, as we've seen above, were really not helping the returns by their quiet activist activity, so had no reason to return to it. But there's a structure in Japan, and in corporate Japan, that didn't change as well. The crisis in Japan, the financial crisis, didn't stimulate a response in the corporate sector. Instead, they went into a more defensive mode. CFOs became even more conservative. Although corporate cross-holdings were at all-time low levels, they are still a powerful force. Related shareholders still can never be expected to vote on proposals that are in shareholder interest, but conflict with the perceived interests of management. Governance Metrics International rates corporate governance by 6 metrics: board accountability, financial disclosure, internal controls, shareholder rights, executive compensation, market for control, and ownership bias, and general corporate behavior. In their global ranking, Japan ranks 34th, just behind China. Domestic M&A is still not a widely available exit strategy. Domestic corporations with cash balances are focused only on external M&A. They do not see domestic M&A as a strategy. Taking private and MBOs are still very rare. There is less attraction to the route of wealth creation for CEOs through privatization. Upper management still prefers the prestige of listing on the Tokyo Stock Exchange. Private equity still exists, but it's a small fraction of levels elsewhere. The recent fight for the shareholders of Renesas between the private equity and government funds reveal that bureaucrats still see national champions superior to private equity investments. So what's next? There are opportunities both for quiet activists and hostile activists in Japan. Analysts have uncovered value. Although the scale is smaller, assets under management are growing again. Both quiet activism and hostile activism have room to grow. Economic reality is that many large Japanese companies have already changed their old systems. This was forced by the great wave of outsourcing to China. Utilization of real estate assets for factories or dorms will never return to old levels. Disposal of these assets is inevitable. Demographic reality means that management is changing. More retirements of senior executives equals less need for management positions, equals more reason to eliminate overlapping and inefficient corporate subs. Legal reality is that corporate law is changing. Therefore, subsidiary listings will be unwound, driven by both legal reforms and valuations. This will drive primarily privatizations, as parents buy the subs, but also takeover bids, LBOs, and MBOs. As stated earlier, minority shareholder rights are high. They need to be exercised. Hostile funds remaining have kept relatively small and try to fly under the radar. In stark contrast, when value funds try to brand themselves as quiet activists, now some of the remaining hostile funds have even tried to rebrand themselves as this quiet activist type. In sum, I would like to go over a couple of the lessons learned from the prior activist era. These lessons yield a couple of don'ts and do's for the potential activist. Don't go it alone. The bulldog defense and the subject popularity of the poison pill means that the threat of takeover is no longer one of the tools in the toolbox of the hostile activists. Activists must work with other shareholders to use proxy voting to promote change, and they must use other avenues available to minority shareholders. Understand the laws. The Murakami Fund understand the legal rights of shareholders, but they didn't understand some of the legal definitions of market activity. Don't alienate the bureaucrats. Don't sue the government. Don't use too much leverage. Structure the funds properly. Activism is a long-term strategy and needs staying power. Some of the do's. Find value first. Be patient. Be the catalyst. Work to create specific events by motivating relevant parties. Engage all partners, including other shareholders, management, boards, and other related parties. Engagement means trying to negotiate with the company to agree and to align their strategies with yours. Be willing to use hostile tools if necessary. Being a catalyst means more than helping managements do what they want to do. It means nudging them to do what they initially do not want to do, but in the end makes economic sense. In conclusion, I would advise investors to look at activist funds or value funds that use activist strategies. Activism worked in Japan. It works now, and it will continue to work. My advice for activist funds, or funds that have activist strategies, is look at Japan. Activist funds willing to go hostile should give it a second look. Hostile activism is difficult. E.J. Graff has said in quite another context, faced with being despised and threatened, the normal human instinct is to hide. You pass if you can. But because it is difficult and unpopular, there are very few attempts in Japan. But this can work. Hostility can work if properly capitalized and executed. It is merely an arbitrage, there for the daring and adventurous investor. Thank you for your time today, and I now welcome any questions.
Mark, thank you very much for your insights and perspective. Anyone who would like to ask a question may do so in our online conference area where Mark will provide answers. I actually have a couple of questions myself, Mark. I'm wondering, one of the things that gets mentioned a lot is the changing equity ownership structure in Japan, more foreign equity holdings, more individuals, less corporations, commercial banks, the traditional stakeholders, is a positive, a catalyst. How do you see that in the context of your comments about shareholder rights are high in Japan but remain unexercised? Could this be a catalyst for positive change?
Well, I think anyone looking at Japan will see how striking the change has been as banks have had to unload their equity positions, their ownership. Other financial institutions has dramatically decreased from, say, 50% of the market cap to maybe less than 20% now. A large part of the growth has been foreigners, but as I stated above, I think there's many types of foreigners, and the large foreign funds, the index type funds or the largest mutual fund complexes, are really hesitant to vote with activists, and very, very hesitant. And I should say they just don't vote with hostile activists. And I think the reason for this is that a lot of those funds really serve two masters. They're serving their investors, but they're also serving potential clients, and they don't want to alienate potential pension fund clients. So I think that some of the switch is deceiving, and although it helps, there's some group of foreigners, say hedge funds or smaller investment funds. It's not entirely clear that the increase of foreign holdings is necessarily going to benefit shareholders in regards to the proxy voting process.
Mm-hmm. And then on the flip side, I guess a lot of the domestic investors, the perception seems to be, well, they won't be a catalyst for change, and they certainly represent the status quo. However, it seems that given the Japanese economy and given that the allocations to equities by pension funds are very, very low, and Japanese individual investors have relatively low equity holdings, with dividend yields higher now than JGB yields, could there be increasing allocations by domestic holders into equities? Is that a potential positive? How do you see that?
Well, one of the interesting things about the Murakami Fund was that when they first started, they were primarily funded by domestic investors, either high net worth or institutions. So there seemed to be a need way back then among domestics for this type of strategy. Some of the reputational things that happened, but I definitely can see it coming back. I mean, JGB yields are, as you said, very low, but domestics really, I think, need to see the results first before they look at Japanese domestic equity, even quiet funds. But they will start looking at these quiet value funds first, and then I think it's going to have to be really performance driven before they begin looking at the hostile type funds again.
Mm-hmm. And I guess related to that, what often is interesting to note in this whole debate is that it's easy to revert in a way to politics and say, well, the foreign shareholders have failed, or the domestic Japanese way of doing things, of the more quiet activism is a better way to go forward. One seems to hear that often, especially given the experience of, let's say, more aggressive funds such as Steel Partners. In your view, is that a bit doing it injustice, and where do you see the rewards for investors the most? What's sort of your preferred way of activism, given what you described as several alternatives out there?
Well, as we always are required to say that past performance is no indication of future results, but as the study showed, the performance of hostile activists was better. I think a number of things have changed. Most definitely the poison pill. But that being said, the whole point of hostile activisms is they do more dramatic. I have every reason to believe that the hostile side will continue to outperform. There are very few hostile funds left. There is most notably one, but very few others. And I think that, but on the other hand, since value is so attractive in Japan, the quiet activisms or deep value funds will also be successful. So I wouldn't really have to pick one or the other. I think they'll both do well from now. But I will have to state that the activists have a better chance of outperforming.
Great. Well, thank you again, Mark, for a great presentation. Anyone who would like to ask a question may do so in our online conference area. Special thanks to Mark, and thank you all for tuning in.